Welcome back. Well, in the recent budget, it was announced that from FY24, returns from listed MLDs, that is market-linked debentures, will be taxed as short-term capital gains versus long-term capital gains, and also that it will be taxed at the investor slab versus 10% currently. And it is analyzed that maybe it will take away the product's appeal, that is the market-linked debentures. Whether that will happen or not, let's discuss this, what the impact could be on distributors of such financial products. We are now joined by Feroze Aziz, the Deputy CEO at Anand Rathi Wealth, to take some questions. Feroze, good morning. Thank you so much for joining us. As we pointed out, the general consensus is that yes, it could take away the attractive fundamentals of MLDs, so to say. What is your take on this? And since it is a big chunk of your revenues as well, how much of a hit it could be?
Hi, Sonal. To my mind, first, it's very important to decipher the new section which has been put in. 50AA is what it's called. It says MLDs which have the full principal component in debt and the return comes from derivative will be taxed at short-term capital gain. This is what it says. The full component, principal component should be debt and the return component should be derivatives. Then it will be classified as MLD or the SEBI definition. So by prima facie, to our mind, the debentures which are unlisted are not covered. Point one. Because the principal is not protected. That's one. Second, coming to your pointed question, will the attractiveness for listed MLDs come down? To my mind, it should not come down dramatically. Because if 10% is there, that was an unfair extra credit which didn't exist to any debt instrument and existed for MLDs, and that had to go away. That's why Anand Rathi Wealth Limited never gave any listed MLDs in the lieu of that 10% attractive tax rate like equity. That's point. Why would it not go away is because there's several silver linings in this announcement, which I don't think people have dwelled on. One is it has not been categorized as interest income, but it is categorized as short-term capital gain. If there is interest income, the income goes into the head of income from other sources. If it goes into short-term capital gain, Section 73 helps you set it off with several other capital losses the rest of the constituents of the portfolio give. That's the one silver lining. The second silver lining is Minister Madam has also said that you don't have to actually now sell it. Even if you mature it with the issuer, you will still get capital gain, which I think is a very, very big gift. Because there is no other debenture which you surrender to the issuer and you don't get a TDS and an interest income. It is now a person does not have to sell before maturity, which was a big pain for an MLD holder. That's point 4. Point 5, Sonal, last one. I probably let me stop here and have some more questions from you instead.
Feroze, you've clearly detailed out the analysis. So just simply put, for our investor in Anand Rathi, what could the impact be?
For the investor in Anand Rathi, the impact could be negligible or nil. Even if unlisted debentures were covered. Unlisted debentures are not covered, that's the prima facie opinion. That's point 1. Point 2, if unlisted debentures are covered, also it's a very, very good thing because with the new tax regime, a family of 4 has several files where there is no surcharge. Even today, if you pay 30 lakh rupees of tax income, the tax is not more than 6 lakhs, which is 20%. So this 39% taxation, which I read on a few print articles, is very hypothetical. 39% doesn't exist to even 500 people in India. So that 39 doesn't exist. At worst, it is 30%. If there are, if a MLD holder gifts this debenture to his major child, who does not have other incomes, then the taxation is as little as 15-16%, even on 2 crore investments. So I personally think it is Nirmala Sitharaman has forced people to think and again come on the driver's seat, just like the second tax regime which has been introduced.
All right, got that. That clarification is very useful. Feroze, just one quick point. If you could tell us what is the current split that you have between MLDs and mutual funds, if you could just help us with that.
So the mutual funds, equity mutual funds of our total assets is 48%. 12% is debt mutual funds. 29% is MLD.
And you're not planning any kind of change in this mix that you just broke up for us right now?
No, we don't want to make any changes because the effective tax rate,
Yeah.
even if unlisted MLDs were counted for the full portfolio which we run, is 14% effective tax rate. And in fact, it becomes a huge business opportunity for us because we are now going to be starting a separate tax vertical, just like we have the estate planning division and the ring fencing division. We're going to start taxation services because when it comes to tax, the full portfolio has to be considered. Not just one individual constituents, because short-term capital gains are under one head. So point is, Anand Rathi Wealth Limited wants to use this huge opportunity to holistically advise people or at least give opinion on the taxation side, especially to 10 crore plus clients. We will start immediately. And that will bring in huge penetration into people's overall wallet share.
Well, Feroz, you would have loved to chat more. We're out of time, but thank you so much for taking out the time to explain this change that has been announced in the budget. So that's the word coming in from Anand Rathi Wealth. No impact, so to say, for the investors for now, but important flashes at the bottom of your screen. LIC is going to conduct a call with the Adani Group to understand their strategy. They are a long-term investor and they follow the investment strategy going forward as well, so they need to take up some more details. We'll get you more details on this one. For now, it's time for a short break. When we return, we'll get chatting with Varun Lochab of HDFC Securities.